Okay, I think we're ready to go here. All right. Thanks everyone for taking your time to be here today. Before we get started, let's get through the preliminary legalities. The CFTC rule, please read and understand the CFTC rule before you risk your hard-earned money in the markets. Our disclaimer tells you that we are not licensed financial advisors, nor are we registered investment advisors. Therefore, we do not provide investment, nor do we provide financial advice or investment recommendations. The webinars provided here, along with all the other information, data, etc., is for educational purposes only. I'm Marco, and this is my email address, optionslam.com@gmail.com. Please feel free to send me a note, a message, a comment, a question. Happy to hear from you. In fact, I look forward to hearing from you. We recently had a webinar and we discussed primarily implied volatility as a stock or a company approaches its earnings release date. The opening slide in that webinar is what you're seeing on the screen today. So let's just review very quickly. What is implied volatility? By definition, and I believe I got this from Investopedia.com, implied volatility is a metric that captures the market's view of the likelihood of changes in a given security's price. Investors can use it to project future moves in supply and demand, and often employ it to price options contracts. Well, I don't know, that's not the greatest definition. Let me rephrase it. Implied volatility is a metric that captures the market's view of the likelihood of changes in a given security's price between now and a certain date, and that would be the expiration date of a options contract. So implied volatility is different depending on what expiration cycle you're looking at. Investors can use it to project future moves and supply and demand, and often employ it to price options contracts. Well, always it's used to price options contracts. It's built into the Black-Scholes options model. So it's more than often, it's always. Okay. Implied volatility is not the same as historical volatility. Absolutely not. Implied volatility is a measurement looking out into the future. Historical volatility is a data set of the actual volatility of the stock price itself in the past. Also known as realized volatility or statistical volatility. The historical volatility figure will measure past market changes and their actual results. In other words, what is the volatility of my stock? It went from 100 up to 120 in a certain period of time. Okay, so the volatility was about 20%. Okay, all right. IV pre-earnings release. In a recent webinar, we studied the IV build as it relates to option premiums as a stock approaches its earnings release date, ER date, earnings release date. We observed how IV, implied volatility, ER date, how IV, that sentence doesn't make sense the way I'm reading it right now, as it changes from an estimated date to a confirmed date. So what we did is we looked at the IV in a certain expiration cycle in a very recent webinar. Was it the last webinar or 2 webinars ago? I don't recall. And we observed how the IV changed from when the market, the whole market didn't know when the earnings date was going to be. They were predicting, and you could see it in the IV bump. The market was anticipating that the earnings release date was going to be, such and such a date in the future, with that weekly option expiration that expired the following Friday. They were predicting, just hypothetically, today, April 20th, with so the options that expire at the end of the week, this week on April 23rd, you could see that there was an increase in implied volatility as compared to the options that expired last week on the 16th. So then when the company comes out and actually confirms that date and says, yes, we are going to have our earnings release date on April 20th, then you could see the implied volatility actually change upon that press release by the company. Furthermore, we also saw how IV follows across expiration cycles when an estimated date is ultimately confirmed into a different week than originally anticipated by the market. So in that example, what we looked at was how the IV was priced into a certain week because everybody was thinking that's when the company was going to announce their earnings. But then when the company actually had their press release and said, no, we're not going to have it that week, what you guys were all thinking, and what was being displayed in the options chain via a bump, what we call a bump in the IV, no, we're going to have our earnings release the week after that or the week before that. And then you could see immediately upon that upon that press release, how implied volatility moved out of the week that we were all expecting that company to report, and IV moved quickly into the other week. Well, what does this all have to do with you and me as traders? Well, a heck of a lot, because implied volatility is a very important, powerful force, as we learned in that webinar, as to how options are priced. And as implied volatility builds, going towards and coming as we approach an earnings release date, the option premium is supported by that implied volatility building, increasing, in other words. Implied volatility post-ER, post-earnings release. Today, what we're going to look at is what happens upon the earnings release itself. What happens once that earnings release is finally there? IV's been building, and now we get to the day when the earnings release is going to actually happen, and then the earnings release is posted at the company's investor relations website. There's news, and IV crushes. This phenomenon is known as IV crush. Okay. Let's get into it now, and we will refer to as we often do, the Thinkorswim trading platform. First, let me go, before we do that, let's take a look and see, go to optionslam.com, and we're going to go to some of the tools that I use to prepare some of the slides that I screen captures that I'm going to present here today. One of the tools is the earnings calendar at optionslam.com. So I know that we have a lot of new users at optionslam.com, and a lot of you aren't familiar with how to navigate around the site, so we'll just touch on that quickly here before we get into the meat of the topic and the subject. Just review a couple of the tools. Earnings calendar, if you're an insider member, you have access to this, you have full control. And what I did is I went back to last week and I looked at there's a few simple filters here, and I looked at stocks that had weekly options, and I might have used a $2 million, 2 million minimum daily volume, and just to see who's got earnings, who had earnings last week, and nothing came up for that date. Let me change the date to the 13th and try that again. And so here you can see that last week we had Goldman Sachs along with JPM, and there's a couple others here. But Goldman Sachs and JPM are two of the ones that I took some screenshots on that had earnings last week. Then the other thing that I use, the other tool that I use, and probably the most common tool that's used at optionslam.com, is the stock screener. It also is found here under the earnings tab. It's the stock screener, and I saved a bunch of different screenings. And if I go to my generic save, it populates all the parameters and filters that I saved. And then I can override that. I can just say, well, instead of looking out for a whole week from today, what if I only look forward 2 days? And then I can resubmit that and get a list of stocks that are going to report within the next 2 days. Now, some of these actually reported this morning. J&J was today before the open. I also took some screenshots of yesterday of that stock in preparation for today's webinar. J&J, PG, and PM. I took some screenshots of those yesterday prior to because they reported this morning before the market opened. So yesterday was the last chance to take screenshots of their options chains pre-ER. And then today we can look at the market post-ER, because today they already announced this morning before the open. So now we can take a look at the current live option chains and see how they compare to the options chains that I took screenshots of yesterday. All right, so that's an interesting tool. And another thing is, if you go to resources and you go to OptionSlam webinars, that's where you'll find the archives of many. I haven't cleaned that up lately, so there's probably 3 years of webinars in there. I probably should go in there and clean that up and get rid of some of the stuff that's getting a little stale. But it's all worthwhile, and there's a lot to learn from taking a stroll through historical webinars, just like the one that you're attending here today. All right, so let's take a look. Let's get started with Goldman Sachs. They reported last week, and JPM, also Chase Bank, JP Morgan, and Chase. Let's see, Goldman Sachs pre-earnings. Okay, let's go there. All right, so here we are. All right, so here's what I want you to notice is that here's the date, 4/13. This is last Tuesday, I believe. And here's the options chain, and you can see this is out of Thinkorswim. You can see that April 16th would have been last Friday, with only, at this point, this is captured out of ThinkBack at Thinkorswim, and you can see the options that expire in only 3 days are holding an implied volatility of 45 points. And then as you go further out in time, those options start to deteriorate in IV. So all of these options, now generally, as you go further out in time, as we know, generally, other than with the imminent earnings event, generally, the further out in time you go, the higher the IV is, right? Because the further out in time, the more time there is for an option, for a stock to move. So obviously, the more time there is, the higher the IV should be. However, that rule is can be violated. Let's use that word for now. When we're coming right on top of an earnings event, because these options that expire here within a week to 2 weeks, 3 weeks, and 4 weeks of the actual earnings release event are really anticipating what's going to happen. What if they have good news? Oh, stock could go to the moon. Oh, what could happen? What if they have bad news? Stock could tank. So there's a lot of anticipation around these weeks that are imminent in the near future, okay? But as you can see, as you go out in time, things level off. 28, 28, 28, 29, 31, 29, 30. Now, I want to pay kind of special close attention to these options that expire further out in time. Generally, we refer to these as leaps, things that expire out, 9 months to a year from now. Far dated options. These are important to take a notice of. So let me pull up another screenshot that I took. And that is, let's see, Goldman Sachs. And this is just a snip, and you can see it's identical to what's happening right here. It's just a picture of this, so that so we can refer to this. All right, so I'm going to just put this over here on my other screen, and we will pull this down. We'll go over to Goldman Sachs. And here we are on the 13th. All right, so we already saw this. We saw the picture that I took. So let's go forward to the next day. Last week, we'll go from the 13th Tuesday to, then they reported the 14th before the open. So let's go to the next day, the close of the next day, the 14th, and you can see what happened to implied volatility. Went from what? What was it? It was 45 for that week. Overnight, that implied volatility got crushed, IV crushed, from 45 down to 35. And ultimately, these other weeks also saw a crush. Look at this next week. It went from 35 down to 28. This week went from 33 down to 28. This week went from 30 down to 29. Okay. And even the subsequent weeks going further out in time saw some IV crush. This is important to note. Granted, the IV crush in those further dated options is not as dramatic, as not as large of a number as the front week from 45 down to 35, 10 points. Okay. But we have to remember that it's not, that IV, as it relates to our options premium, is controlled by the Greek. Oh no, not the Greeks. Yep, the Greek called Vega. So Vega, and I'm not going to get into discussing the Greeks right now today, because it just takes me down a whole nother rabbit hole that we don't have time for. But maybe we'll get into that in a future webinar. I'm sure we'll get into it in a future webinar. I promise you we'll get into it in a future webinar. In the meantime, you can just study it, Google it. I don't use Google search engine. I use DuckDuckGo now because I don't feel that they. Anyway, that's another subject. It's a privacy issue. But let's take a look. Now, why did I say pay attention to these weeks down here, these leaps? Remember, they were at 33, 31, 32. These are further dated options. These are leaps. These are way out in time, 33, 31, and 32. Well, what happened to those? 33 went to 32. This is overnight. This is a one-day event. This is the pre-earnings release to the post-earnings release, end of day statistics. Okay. This is documented numbers, Can't change them. This is the real deal. 33 went down to 32. 31 went up to 32. 32 stayed at 32. Basically, they were all hovered right around. They were not affected very much. Apparently, they were not affected very much at all by the earnings event that happened that day, 4/14 before the open. They're too far out in time. However, everything else seems to have seen some kind of an effect. All right. Now, this goes to predicting IV crush. I pay very close attention to these leaps when I'm trying to predict IV crush. Well, Marco, why do you want to predict IV crush? Because IV building has an effect on my option strategy. IV crush also has an effect on certain option strategies that I play around earnings events, such as iron condors, selling strangles. I'm not a buyer of strangles because they are, especially at earnings events, because they suffer from IV crush. But selling strangles, selling iron condors, selling premium benefits from IV crush through that Greek known as Vega. So I want to have a handle on how much IV crush to expect if I'm going to be playing one of those types of strategies, such as the iron condor, for example. All right, so let's take a look. Let's move on to 4/14. Now there's only 2 days left. You see over here, there's only 2 days left till these options expire. Let's go forward one more day. 4/15. Oh, 35 crushes more, down to 31. Let's pull up that other snip again. Where did that snip go? GS. Oh, come on. There it is. All right, so you can see some of these closer dated option expiration cycles are crushing even more, but these leaps are holding strong. Okay. And let's go forward another day. Let's see, the 15th is Thursday, so let's go forward to the 16th. And now these front options are losing IV almost 100% because all options come expiration day will ultimately have no implied volatility left. Those front options, those front week options that expire today, which in this example was 4/16/21 last Friday, by the end of that day, there will be no implied volatility left. Your options will have only intrinsic value. They'll either be in the money or they will be out of the money. They won't have any extrinsic value, and extrinsic value is the place where implied volatility calls home. Okay, implied volatility lives in extrinsic value. So once your option expires at the end of the day, 4/16, it's either in the money and has intrinsic value, or it's out of the money and it expires worthless, and there is no more implied volatility to be concerned about in an out of the money option at the end of the day on expiration day. Okay? All right, so there was an example. Let's go to another example last week. JPM. Same day. JPM, 4/13, pre-earnings release, screen capture, pre-earnings release. The front, same day. They both, JPM and Goldman Sachs both reported that same day. And let's see. I did this again too. I just captured this so that we don't have to flip back and forth quite so much. So I just captured this, so we have it. All right. So here's that front week that expires in 3 days. Here's the leaps that go out into time: 30, 30, 31. Okay. 30, 30, 31. Let's pay attention to those. And let's go to JPM here, to the live, JPM, to the think back module, and we'll go to 413, okay? And that's the snip that we just saw. And now we'll go to 414, the day after JPM, pre-ER. There it is. Okay. All right. So for reference, there's the pre-ER IV, and the post 1 day went from 37 down to 25. Big crush. How about the 1 week out? From 31.7 down to 25. From 28 down to 26, from 31.5 down to 27. You can see the point here is, what's important to note is you don't have to play the front week weeklies that expire in 3 days. You can play in your earnings strategy. You can play options that expire next week, next month, 2 months from now. They're all going to experience IV crush, and the further out in time, the higher the Vega factor. So even though they don't crush quite as much in raw numbers, those further dated options have a higher Vega factor. So even though they crush less points, the multiplication Vega number is a higher number the further out in time, which kind of offsets that very much so, okay? But let's look at those leaps. 30, still 30. 30.5, still almost 30.5. 31.5, still right in the same ballpark. Not affected so much by today's current events. Okay? They're just a little bit too far out in time. But they can be used as a gauge in estimating how much IV is going to crush. We know that IV is going to crush, but it's not going to crush to a point that's higher than these leaps, okay? IV is going to crush to a point that's lower than these leaps. And we saw that in both examples, Goldman Sachs and JPM. So now I have a limit, I know the max IV is going to be after it crushes in these shorter dated options. The max it's going to crush to is it's going to crush at least to 30 and probably more. At least to 30 and probably more. All right, let's go the next day. We're looking at 414, which was Wednesday. Let's go to 415, which is Thursday. More crush. Okay, more implied volatility crush happening there. And I got so many windows open. I'm sorry, I've got too many windows open. And there it is again. 37 went from 37 down to, what was it? 25, now down to 23, 31 now down to 22. And those leaps are still holding strong at 30, 31 zone, okay? All right, now let's move on to some more current examples. Let's look at Johnson & Johnson. All right, let's look at Johnson & Johnson pre-ER. Johnson & Johnson, this is yesterday. This snapshot was taken just yesterday during the live market hours. And this was the implied volatility of the options that expire this coming Friday, April 23rd. Johnson & Johnson, as you know, in the news, vaccine this, vaccine that, et cetera, et cetera. asbestos in the baby powder. That, yep, same J&J. I don't mean to belittle the company at all. I'm actually an investor. But here the point is implied volatility. Earnings release coming up today before the open. Okay, so there's that screenshot. And let's see, did I take a snip of that? Let me see if I got a snip of that. If not, no, I didn't. But here, maybe I could just, yeah, let's try this. There. Okay, that'll work. All right, so there's J&J. Let's go to the live options chain right now, J&J, live options chain right now. And, you know, let's see if I can make room for that other, oops, not that one, this one. There we go. All right. So there we were yesterday. 25 was the, so now this is important to know. J&J, JPM, these are stocks that don't have incredibly high implied volatility. I'm picking on some of the stocks. This is an important note for me to mention here. I'm picking on some of the stocks here that you say, oh, that stock doesn't have that much of an implied volatility, probably doesn't have that much impact on those stocks because they just don't move that much. Well, it's not true. Implied volatility has a very strong impact even on these stocks that don't have huge IV build and they don't have huge IV crush. Look at a stock like Netflix. Huge implied volatility, huge IV build, huge IV crush. We'll take a look at Netflix. There's many, many other stocks, some of the higher flyers. This effect is even more substantial in those higher flyers than it is in these stocks. So I'm using these stocks because they're current examples, firstly, and secondly, because to prove a point. It matters even on these stocks that don't have huge implied volatility. It comes into play. So now the next thing we're gonna do, I'm gonna look at a couple examples, live examples, and then we're gonna look at how this affects option premium. We're gonna apply this to strategy, okay? So first, let's look at this example, this live example. Here's the pre-earnings IV. Here's the leaps, okay? And here's, let's see, J&J, and let's go to the live options chain right now. Let's take a look. I don't know, J&J was powering up. Okay, so if you look at the price chart here of J&J, it gapped down this morning, okay? So initial reaction to the earnings release before the open this morning was not real positive, but it didn't really even go test anything below that. Apparently, there was a conference call at a similar time as the announcement, and this stock is just powering up. Earnings, obviously, as we all know, has a dramatic effect on options on stock prices, right? And that's and of course options being a derivative, therefore a leveraged derivative, very strong impact also on options premiums. So anyway, there's the price chart. Let's go back to the live options chain. Let's take a look at all right, so we have the okay, so IV has not crushed very much here on this one yet. 24.99. Okay, so I'm a little surprised to see that. I'm surprised to see that IV has not crushed very much yet on this one. But when you get a strong movement in the underlying stock, this can sometimes take a bit for IV to actually start to crush. So so there's the live chart on that one. So let's look at another one. PG and PM. Take this one down, and then this is live. PG, Procter and Gamble. Okay, Procter and Gamble live, and PG pre-ER is right here, and we'll take a look at that right there. So you can see PG, Procter and Gamble. This is the pre-ER capture, 32.7, huge IV crush from 33 points down to 21 points overnight, okay? So there's the IV crush there, and then you can see the subsequent weeks. And out to the leaps, not much of an effect. So the rule holds true, right? 24 is still 24, 23 is still 20, is now up to 24, 23 is just under 23. So again, very little, apparently no effect in those leaps, but dramatic effects in all the other options. Predicting IV crush, we know IV is going to crush to a point that's going to be below the leaps, probably somewhere in between the 1 day crush I'm talking about. The 1 day crush is going to be below, it's going to crush into be below where the leaps are, okay? It's going to crush at least that much, and probably very close to where some of these other options hover around the 20, 22, 21 range, and sure enough, it did a crush to there. So, you know, it's yet to be seen what happens tomorrow. Okay, so in the interest of time, I'm going to not show any more examples of that. I've got a bunch of different examples, but I want to get to some option strategy as well. Okay. Let's see, we'll close that. And let me just power of VK. Lots of examples. All right, so now let's take a look at, I mentioned Netflix. Let's take a look at Netflix. Well, why Netflix? Because when we go to our earnings stock screener and we apply some filters, we learn that Netflix comes up on our list. All right, so there's Netflix going to have earnings today, woohoo, after the close, April 20th, after the close. Just a tip for you new folks, you can right click on Netflix here and open that link in a new tab. That's going to take you to the Netflix stock specific pages where you have all of these different pages that study the Netflix historical statistics. I just realized I forgot to shut my phones off. So let's see. Let me do that right now. We're lucky we haven't been interrupted. Sorry for this interruption, but it's better than the phone ringing, I think. Let me get the other phone shut off. A bunch of texts were coming in there, and my phone was vibrating on the desktop here, and then I realized that I'd forgotten to shut it off. So, okay, we got that out of the way. The phones won't ring now for sure. All right. I sometimes forget to shut those phones off. Sorry about that. All right, so Netflix came up on our list, and we have all of these different pages. The black bar now turns into a bunch of different links where you can study different aspects as to how Netflix behaved on earnings dates in the past, okay? Scroll down, see the tables. We're not going to get into that. We don't have time for that today. We've reviewed all of these pages many times in the past in previous webinars. Again, you can find those under the Resources tab, Option Slam webinars. Also, by the way, we have a very powerful tool that I don't think many of you are aware of or maybe don't use. I use it almost every day of the week. OSBTT, Option Slam Backtesting Tool, is a very powerful backtesting tool. It is limited to end of day data, but it is very powerful to build a database of your strategy and prove to yourself that your strategy worked in the past before you apply real money to it in the future. Okay? Very important. Prove to yourself that your strategy worked in the past on your stock before you risk your real money on a real trade in the future. All right. Netflix. Let's power this back up. Let's go to Netflix and FLX. Now, Netflix is a high flyer, gets huge implied volatility build. Look at the IV here. We were looking at 25s and 35s in some of those examples. Netflix sporting a 78 IV as it approaches its earnings release after the close today. And look at some of these other implied volatilities further out in time, 53, 46. What's going to happen to these numbers? 77, by the end of the day tomorrow, I predict will be less than 36. Will be less than 36, 37, okay? IV is going to crush. Now, is it always going to crush? No, we just saw one example where it didn't crush that drastically, but 9 times out of 10, okay, if not 95 times out of 100, IV is going to crush, and it's going to be lower than, it's going to crush to a point that's lower than these leaps. It's going to crush to a point that hovers around the median range of these options that expire out 2, 3, and 4 months. That's where IV is going to go tomorrow. Now, why is that important? Well, if I were going to put on an iron condor that's let's see, if I measure the implied move, and by the way, we have that data right there at Option Slam, so you don't have to do a whole lot of research. The implied volatility, let's see, I'd have to open this up to go to the weeklies. I have to open up this weekly thing here and see what was the, as of April 15th, let's see, what was the last capture? Let's see. Implied volatility. Here we go. The last capture. It's right here at the top. I'm sorry. I was looking for it in the table, but it's easier to find. We made it easy. The implied volatility weekly. So the options that expire this Friday, this coming week, are pricing in a 7% move. Okay, 6.7% move. That's what's being priced in to the options that expire this week. The options that expire the third Friday of May are pricing in a 9% move between now and the third Friday of May. Okay, a 9% move, about a month away. Okay, let's go back to the chain, options chain. All right, so 7% move for the options that expire this week. Let's just build an iron condor quickly. So here's how we use our estimated IV crush. Okay, here we go. Let's see, we got a stock trading at about 547. 547. I'm going to punch this in on my calculator on my desktop. Times 7% is $38. So let's look at options that are about the implied move away, about 7%, 38. So I'm going to go to 548. I'm rounding this to 548 plus 38 points takes me up to the 586. So I'll just go to the 585 because there is no 586. And let's sell an iron condor, for example. Okay, this is how we use this information now. Let's sell an iron condor. So we sell the 585. I'm going to manipulate this to be the 585 by 595. I want to go 10 points wide on this one. And then I'm going to go that 548 minus 38. That would be 548 minus 38 takes us down to the 510 strike. So let's manipulate this put down to the 510 put. So building an iron condor here, 510, and we're going to put to work, and then I'm going to buy a put 10 points below that to define my risk. So I'm going to go down to the 500. So there's our iron condor. Selling the 585, buying the 595. Selling the 510 put, buying the 500 put. Let's take a look at that in the risk profile. And there's the current price. Let's delete that other slice so we don't get confused. And let's shade this out to the 23rd so we can see where one standard deviation is based on Friday. The way Thinkorswim works, they actually use the technical, they use the 24th. So I'll do that. I'll use the 24th, even though it's Saturday. But technically, that's when the options actually do expire. Okay, so that there is no IV left on Saturday. Obviously, the market isn't even open. But okay, so you can see this iron condor is well positioned. Not a recommendation, because there is risk in it. In fact, the risk to reward is make $300 is the maximum profit. Therefore, the maximum loss is lose $700 in round numbers, right? In round numbers, 320 by 680 would be more accurate. A risk of 680 to make 320. So that's the risk reward ratio is 320 by 680. Risk 680, reward 320. Okay, so there's an iron condor. It's got a high probability of being a winner. However, the risk is somewhat substantial. Now, another thing you can do over at optionslam.com is take a look at what happened in the past. You can go to Implied Move Weekly page and see how did this stock behave in past events. And so this graph, I love graphics. I'm a graphics kind of a person. I love data tables and Excel workbooks as well. But graphics make it easy for me to see that an iron condor placed on Netflix last quarter would have been a loser, because this is the implied move, this orange candle, this orange rectangle, okay? That's the implied move going into earnings, and price was in the middle here. And then here's the actual one-day move. So the stock actually moved outside of the implied move substantially last quarter. But what happened in some previous quarters? Inside the implied move, inside the implied move, inside the implied move, inside the implied move. Aha. So 4 out of the last 5 times, it looks like the iron condor would have done well. Now, I can't say that emphatically for sure. I don't know. I don't have the backtest data to support that. I'd have to actually go into OSBTT and do the backtest, because depends on not only the one-day move, but what happened over the next 3 days. Or if I chose not to use the front week expiration cycle and I went out 2 weeks or 3 weeks or a month or 2 months to do my iron condor, I would have to evaluate that with around those parameters. So, but my first initial glimpse at this is that the IV crush would have come in to benefit me immediately historically. So obviously this one was a loser in an iron condor. Okay, obviously you would have probably lost For sure, if you did the front week weeklies. Now, over time, had you done a month out, actually, I think this one actually played out okay if you would have traded a month out. I'll show you why I say that. And I can do that simply by just going to a chart of that stock and looking at, okay, so here's that last quarter. There's that big move. Let me zoom in on this. Okay, there it is. There's that huge move. Now, within 3 days, yeah, that's still way up there. But within a week, had you gone out to the next week, look what happened. If your iron condor would have been positioned, let's see, I'm not going to take the time to do this, but just let's say, had your iron condor had been positioned 30 points out, let's say 501 plus 30 points is up to 540 up here, okay, on the call side, look, within 1, 2, 3, 4, 5, 6 days, guess what? And 7, 8, 9, 10 days, guess what? 11 days, guess what? Those iron condors would have paid out, okay? A month out, boom, look. That would have paid out. 3 days out, not so much. Guaranteed loser right here, 3 days out. You follow me? You see how I can assess that right from the price chart? Okay? Now, to get a firm handle on it, you need to go and actually put it in the OSBTT and download the results, build yourself a database, and just see how things played out to determine whether you want to play front week weeklies or 2 weeks out, 3 weeks out, next month monthlies. What works best for your stock, historically speaking, and use that information to help guide you in making decisions in what trade you're going to put on today's earnings event or whatever the case might be. All right, let's see. Another one. Let's see, you need to get your questions in the chat box. We're starting to run out of time here already. I see there are a couple questions. Let me just review those quickly before I move on. Barney, yes, it's recorded. Let me make sure. Yep, it's being recorded. Sometimes I've had that recording button do funny things on me in the past, but yep, we're all good. You'll get email tomorrow. Also, if you're a insider member, you'll have access to the recordings right at the website. Quite a few people asking that question. Let me get past those questions. The tip for looking to leaps is to determine the IV crush for the near-term option is great. Do you have any other tips for predicting IV crush? Yeah, the other tips are to go and look at historical. So use ThinkBack. Use ThinkBack. So we go to Netflix and okay, so here's what we can do. That's a great question. So we'll go to Option Slam and we're on Netflix, and pretty much any of these pages that are in the black bar up here we'll have a table below that gives you the historical earnings dates. So here we can see January 19th was the last earnings date after the close. Now, it's important to make note as to whether the earnings release was after the close or before the open. If the earnings release is before the open, such as in Goldman Sachs, like we saw earlier, Johnson & Johnson, Procter & Gamble, all those examples, JP Morgan, all of those examples, those companies all reported before the open. So we have to go to the day before in ThinkBack to get the pre-earnings IV stats. And then we can move forward in time. So let's do that with Netflix. Let's go to January 19th. Now, after the close, we actually go right to January 19th. We don't go to January 18th because January 19th is the day, is a trading day prior to the earnings event. The earnings event is January 19th, but it's after the market closes. So the first day, trading day, would be January 20th. So let's go to do that. All right, so we'll go into Netflix, go to this Analyze tab, we'll go to Think Back, we'll go to January 19th. All right, so the other tip that I have for you is use Think Back. January 19th, Think Back was the IV was 89. Where did IV go? I simply, all I need to do is go forward a day. All right, so here's an example of it didn't quite crush because, again, just like Johnson & Johnson today, when you have a big move, when you have an outside the implied move, IV doesn't crush as dramatically as it does when you have a more of a muted move. It takes a little more time, but there is no doubt that by the end of the day, Friday, these options that expire this the Friday after January, the options that expire on January 22nd, by the end of that day, this IV will go to zero. Okay, it will go to zero. So the IV one-day crush here was not quite as substantial because it was a huge move. Remember, that was a big move. It was a double the implied move type of a move. Okay, but let's go forward again. Now the second day we get a bunch more crush. Now we are sub leap area. Okay, 42, 42, 40, 41, 39. We are sub leap area now after 2 days of crush. Okay, so what else do we have? Let's not just give up there. Let's go to the October 20th event. The October 20th earnings event. We simply go here and go back to October 20th after the close. So here's the pre-earnings. Woo, 99, baby. 99 almost, okay? There we are with extremely high implied volatility. And now this was not as extreme of a move. This was more normal, more in line. If you'll remember, the data from Option Slam showed us a chart where this earnings event, the actual one-day move was it was to the implied move. It was right to it, but it was not outside of it. It was within the implied move. So let's see what happens to IV crush from a 98 one day down to 42. Bam. So you can see there that only took 1 day to get inside of my leap zone. My leap IV zone is up here at 46, 48, 47, 45, and 41. And we were able to get sub-leap zone IVs in a 1 day move. All right, so what does that do to our IV in our implied in our iron condor? So here's our iron condor. Now what we can do with the power of this tool is we can click on this gear icon and we can see that we've got, and then we've got, all right, so we've got, let's look at the options chain again. We've got an implied move right now of 78. We're expecting implied volatility to crush to sub leap zone 39, 37, 38, 37. Sub leap zone is going to be 37 or lower, okay? 37 or lower. We're at 78 now. So what we do is we take 78 minus 37. We're going to be at least down to 37 tomorrow. 9 times out of 10, right? Not always, but 9 times out of 10, we're going to be sub-leap zone by the end of the day tomorrow. So 78 current minus the leap zone of 37 equals 41. I should do that on a whiteboard, but we're hurting for time here. We're already over our allotted time for today's webinar. So that would be a crush of 41 points. So what I did is I said 78 current IV minus leap zone 37, we're going to have at least a 41 point vol crush overnight, okay, by the end of the day tomorrow. So what we do is we go to our tools in our Think or Swim Analyze tab, and notice I'm on the Analyze tab. I'm in Risk Profile, and I've modeled up a trade, and I'm going to do negative 41 IV points by the end of the day tomorrow. I'm just going to, what will this risk graph, this purple line, look like if we get 41 points of IV crush overnight, or not overnight, but by tomorrow, end of day? All right, so I put in negative 41. That's the minimum amount of IV crush I expect to get. And looky there, that 1 day risk graph. And if we move forward a day from the end of the day today, because that IV crush isn't going to happen today, it's going to happen tomorrow. If we go forward to the end of the day tomorrow and we manipulate the IV crush and 1 day of theta decay, it looks even better, right? See what happens when I do that 1 day of theta decay? Here's today's risk graph. If we get the 41 points of IV crush today, this is what's going to happen. But we're not going to get it today. It's not going to happen today. It's not going to happen until after they report their earnings release today, after the close. So after one trading day, by the end of the day tomorrow, let's move time forward magically by clicking this forward 1 day. This is what the risk graph will look like at the end of the day tomorrow. So tomorrow, if price moves from here all the way down to here, you're going to be underwater slightly, and you're going to be living on the edge. We have webinars in our archived webinars on how to handle that. I've got adjustment ideas in past webinars right in our archives on how you can handle that kind of a move if you're in an iron condor like that. Some ideas to consider, adjustments to consider. But if price doesn't move too much, and let's say it moves right to the implied move, you're going to be at a break even by the end of the day tomorrow. That's right where the break even is at the end of the day tomorrow. But if you can hold on to this trade and price doesn't continue to deteriorate, or on the other hand, accelerate, because we don't know which way price is going to go, but we do know time will go forward. We do know time will pass. We can't stop the clock. And we go to the 22nd, and then expiration day, the 23rd. And by the end of the day, Friday, the purple line becomes the green line, and now you are at maximum profit in an iron condor as long as it stays inside of this zone. All right, well, folks, I got through the material. The only other thing I have for you, let's see, do we have any other questions? Yeah, Dion asks about calendars. Calendars are more, okay, I'm glad you asked about that because I don't have time today, but Magesh, you're welcome. You got cut off there. Yes, I'm doing fine. Thank you, Magesh. Okay, very good. All right, so let me go back to, I got 2 more minutes. I'm going to take 2 minutes more of your time. There we go. Okay, so Dion asked about calendars. Calendars are much more affected by implied volatility swings and fluctuations. Okay, calendars are much more sensitive than vertical trades like the iron condor. Even though you saw that an iron condor is very much dramatically affected by changes in implied volatility, IV crush, specifically in the example that was illustrated today, calendars are affected also very dramatically and very much differently, very much more sensitively, because calendars and diagonals are horizontal trades over time, okay, where you're dealing with different expiration cycles, and those different expiration cycles are affected differently by implied volatility changes. So a little bit more involved in a little bit more involved, and I'm sorry, I can't think of the word I'm looking for. But the next webinar coming up 2 weeks from today, I'm going to discuss a strategy that I've been working on for quite some years now. And I'm going to reveal my personal core strategy, the strategy that I play pretty much every day of the year. I have one of these trades on, if not several, sometimes many of these double eagle trades on in my own personal account. And there will be an opportunity coming up to learn about the double eagle. And we're going to have a workshop. It's a paid event. It's not going to be a free webinar. Now, 2 weeks from today is a free webinar. It's an introduction to the double eagle and the work that I have prepared in the background to support this strategy and to support the people who are trading this strategy. Okay, I'm going to reveal a lot of information about the strategy, and in the past, so far up to date, only a select few traders have been on board with the progress of what we've been doing to support the traders who trade the double eagle, and we're going to make available to you, everyone who's here today, an opportunity to get into the next intensive 5-week training event, which is going to begin on Saturday, May 15th. It's going to be a 5-week long training workshop, which will meet once a week for 5 weeks, where I will teach my core strategy and hold nothing back. No, what's the old saying? No holds barred. Okay, so that's coming up. Make sure to keep an eye on your email for the introduction to the webinar coming up 2 weeks from today. I believe it's 2 weeks from today. May 4th, I believe, is when that next webinar is going to be coming up. So everyone, thank you so much for being here. Thanks for your time. And we will look forward to seeing you in a couple of weeks at the next free webinar brought to you by optionslam.com. Goodbye for now, and good trading.